Investing with a focus on environmental, social, and governance (ESG) factors has become increasingly popular in recent years. ESG integration involves incorporating ESG considerations into investment strategies to achieve both financial returns and positive societal impact. In this tutorial, we will explore how ESG integration is applied in both active and passive investment strategies. Investing with a focus on environmental, social, and governance (ESG) factors has become increasingly popular in recent years. ESG integration involves incorporating ESG considerations into investment strategies to achieve both financial returns and positive societal impact. In this part of our ESG tutorial, we will explore how ESG integration is applied in both active and passive investment strategies. Active ESG integration refers to the process of integrating ESG factors into active investment management decisions. This approach involves actively considering ESG considerations when selecting and managing investments. Here are the key steps involved in active ESG integration. 1. ESG analysis. The first step in active ESG integration is to analyze the ESG factors that are relevant to the investment decision. This analysis may involve assessing a company's environmental impact, social practices, and governance structure. ESG data providers such as MSCI or Sustainalytics can provide information and ratings on various ESG factors. 2. ESG risk assessment. Once the relevant ESG factors are identified, it is important to assess how they may impact the investment's risk and return profile. This evaluation involves considering both the financial materiality and the impact on broader ESG-related risks and opportunities. 3. ESG integration in investment process. After assessing the ESG risks and opportunities, active ESG integration requires incorporating this analysis into the investment process. This can include incorporating ESG factors into financial models, adjusting valuations, and making investment decisions based on the integration of ESG considerations. 4. Engagement and active ownership. Active ESG integration often involves engaging with companies to promote positive change. This can involve dialogue with management, proxy voting, and participating in shareholder resolutions. The aim is to encourage companies to improve their ESG practices and create long-term value. Passive ESG integration, also known as ESG index investing or ESG indexing, involves replicating the performance of a specific ESG-focused index. It aims to provide exposure to companies with high ESG ratings while maintaining a similar risk-return profile to a traditional market index. Here's how passive ESG integration works. 1. ESG index selection. Passive ESG integration starts with the selection of an ESG-focused index. These indices are constructed using ESG rating methodologies that take into account a company's ESG performance. Examples of popular ESG indices include the MSCI ESG Leaders Index, FTSE4Good Index Series, and S&P 500 ESG Index. 2. Index tracking. Once an ESG index is selected, passive ESG integration involves tracking the index's performance. This is typically achieved through investing in a basket of securities that replicate the index composition. Passive ESG funds, including ETFs, exchange-traded funds, and index funds, are common investment vehicles used to achieve this. 3. Rebalancing. ESG indices are periodically rebalanced to reflect changes in the ESG ratings of constituent companies. Passive ESG investors need to regularly adjust their holdings to match the updated index composition. This ensures continued alignment with the ESG investment strategy. 4. Exclusions and inclusions. Passive ESG integration may involve negative screening, which excludes companies involved in controversial activities or industries. Additionally, companies meeting the ESG criteria may be included, even if their weightings in the index differ from a traditional market cap weighted index. ESG integration can be implemented through active or passive investment strategies, depending on the investor's preference. Active ESG integration requires thorough analysis, engagement, and ongoing management, while passive ESG integration aims to replicate the performance of ESG-focused indices. Both approaches aim to align investors' financial objectives with broader sustainable development goals. It is important to consider ESG factors, as these provide investors with the opportunity to make positive impacts while seeking financial returns.